So, what I want to talk about today is options. That's kind of my passion, and it's kind of, I think, kind of magical at times as to what you can do with options. So we're going to talk about options for income here and a 5-step plan that I've put together to share with everybody here today. Basically we're going to go over the, how to avoid that #1 option trading mistake, the most important option factor, how, option pricing works, and knowing and using the market maker secret, what that is and how you can use that to your advantage. And then the highest probability option strategies for every market to kind of get you familiar with what's out there as far as income strategies. So first off, let me say that the following webinar is purely for educational purposes only, and any stocks mentioned does not constitute advice and should not be construed as recommendations. So first off, let me introduce myself to you. I've been actively trading for over 30 years and started out my trading primarily trading oil, cargoes of crude oil. Back in the 80s, I became the executive vice president for one of the largest oil trading companies in the world and ran their international trading desk out of Bermuda for over 10 years. And pretty much, if it moved, we traded it. We traded all the different derivative markets, the bond futures, S&P equities, you name it, we traded a lot of physical oil. And got involved in crude oil options back in the mid-'80s. And we started trading those over the counter at that time on cargoes of oil, mainly North Sea Brent crude oil and a lot of the other ones. But that's where I got introduced to options and kind of fell in love with it from that point on. I went on to launch the over-the-counter crude oil option brokerage desk for PVM Oil out of London. They're the largest privately owned oil brokerage company, and that was another fantastic experience for me as far as learning, a lot of the different bigger option structures and getting involved with some of the big institutional banks and hedge funds. So it was a lot of fun. Also another great learning experience. So, what I'd like to do here today, though, is first off get a feel for everybody that's here. And if you could just put in if you'd like to be more active in the markets trading, maybe as a full-time job, but you're not quite there yet, if you just put a yes or no in, I just kind of like to get a feel for everybody that's here. Excellent. So lots of yeses in. And I just want to say that, I can remember when I first started out, I've been trading for over 30 years, but my trading first started out just trading OPM, other people's money. And what I learned, and I learned it very quickly, was that trading OPM is way different from trading your own account, your own hard-earned dollars. So I had a lot of major learning experiences, moving forward on my trading. And some were not too pretty to start with, but you do learn pretty fast from your mistakes. Now, trading my own account, it really started to improve once I started doing a better job of controlling my risk. And the huge breakthrough was really learning how and then committing to limiting my downside in any trade taken. And I do this by primarily using options and option spreads. And the really big aha trading moment for me also came when I started taking advantage of option premium collection type strategies in my trading. So once I learned, to do this, it became a totally different game for me. And I also could sleep a lot better at night knowing, what my risk was, controlling my risk, and being in more control of my trades. And the really cool thing, too, about option strategies, that it does allow you to completely control that risk by using different trade setups or spread setups. So you decide ahead how much risk you're going to take. And then you implement it and put it into your structure, and you know where you are. So it's really that simple, and that's why I'm really excited here today to be talking to you guys about income strategies and how you can use those to take advantage of a lot of the great potential that options offer you. So that being said, let's get rolling here. So ask yourself this: if you could add a new stream of income now, would it change your life? And if the answer is yes, then you have a plan to achieve that goal. Well, the first step that we're going to look at as far as a plan that I think can help everyone is the #1 option trading mistake. So, option trading has many more advantages than trading stocks, but it's a bit more complicated. And for somebody just starting out, it can be also a little intimidating. That's why many investors decide to begin trading options by buying short-term calls, especially the out-of-the-money calls where you have the strike price above the stock price itself. And it's that familiar pattern that we've always kind of learned throughout our life is, you hear the saying, buy low, sell high. But, is this really the best option strategy to use? So let's go through an example, and hopefully this will illustrate that there are other ways to trade options other than just to buy. So imagine you're bullish on Facebook and it's trading at $65. Now, as a beginning option trader, you might be really tempted to buy call options that expire, for 30 days expiration with a strike price of about 80. Because you look at it and you can see, wow, those things are going for 15 cents per option, and that's $15 per option contract. Now, if you look at this, you think, wow, I can buy a lot of those, so I really do like the potential for this. And then you go through the math and you really get excited about the potential that it offers you because of the leverage that options provide. Now, you could purchase 100 shares of Facebook at $65, and that would cost you about $6,500. But for that same $6,500, you could buy 433 contracts of those $80 calls and control over 43,000 shares. So when you do the math on that, you're thinking, man, that is just incredible. Imagine if Facebook was to hit $81 within the next 30 days, and those $80 calls then are at $105 per option contract just prior to expiration. Well, you look at that, you do the math, and you think, man, that's over $38,000 in a month. I love this option buying type stuff. I can be, really rich in a very short period of time. And then I look at my initial investment, that's just an incredible return. So the first glance, that kind of leverage is very awesome. But you don't let the glitter fool you. There's usually something else that you're not aware of when you look at situations like this. So the one problem with short-term out-of-the-money calls is that you not only have to be right about the direction, but you also have to be right about the timing. Now that ratchets up the degree of difficulty, and to make a profit, then the stock doesn't need to just go past the strike price, but it also must do this within a defined period of time. So in the case of those 80 calls on Facebook, you need the stock to reach $80 within 30 days to make a profit. All right, so so then in the case of those 80 calls, then you need that stock to go to $80 within 30 days to make that profit. So, again, being close means no cigar. So imagine, though, the stock rose to $75 during the 30 days of your option lifetime. Now, you were right about the direction of the stock, but since you were wrong about how far it would go within a specific time, you still lose your entire investment. So based on that newbie option trader mistake, really a better goal for every trader, in my opinion, would be to select trades based on what provides the most consistent positive returns, not just the biggest. And the best way to really do this, to achieve this, is by using option strategies that take advantage of selling options for income generation. Now, by selling options, we're, in essence, selling time. And an option is, basically like a coupon. Imagine that. So, they must be redeemed by expiration date, or else they're just going to, be worthless, no longer valid. So, but how is this done, and what's involved, when you're selling an option, and how does it all kind of work? Well, step 2 then is the most important option factor for income generation, and that's time. So, what is time? Time value in options is, is when you're trading income options, you're using this time value. That's part of the strategy, and it takes advantage of that accelerated time decay that options have going into their expiration. Now, option income strategies, again, are very, very tied to time value and the impact that has on the price of the option. So time value, which is also the intrinsic value of an option, is a premium the rational investor would pay over its current exercise value, the intrinsic value, and that's based on its potential to increase in value before expiring. So this, probability is always greater than 0. Thus, the option is always going to be worth more than its current exercise value when you get into it. So time decay, again, it goes to 0 at expiration. And the general rule is that it will lose about 1/3 of its value during the first half of its life and 2/3 in the second half. Now, as an option moves closer and closer to its expiration, moving its price requires, a bigger, larger price move in the underlying security. So it's, again, kind of like swimming against the tide. As you're going towards expiration and your long options or buying options, you're really going into the wind because you're getting clicked or hit every day by time decay. So here's an example just to show you a time graph and what that looks like and what that does to your to your option. So here you can start out 120 days out basically, and you can see on the graph this very, very slow time decay, or theta decay we call it in option terms. So when you're starting way out here, you're only losing about a penny a day. Now as you get further in, 60 days out, 30 days out, and then you get into the weekly options, you start losing 5 cents, 10 cents, 15 cents, and it really increases until before you know it, you're down to 0, and you're no longer have any value to that option. And that's strictly if the market's going sideways and you do nothing. That's because of that time decay that's going against you. So then how does that affect pricing? How does this all kind of pull together for a pricing of an option? Well, basically, to price an option, it's just the time value. The basic components is time value times implied volatility times that intrinsic extrinsic value. So once you know these variables, then you can, you're ready to price that option and know what its option premium should be. So this is the, basically the key components, and those are knowing what the implied volatility is. So in the marketplace, the implying the volatility of the stock, that's what it is, being implied in the future, and it's based on the price changes today in the option. So, you can get a big spike down, which increases your implied volatility one day, and the next day it can go up, and you still have a fairly good higher implied volatility or a higher premium because of that spike in volatility. So it's based on, the current day's action, but then, a few days later it can calm down, but you're going to still have an elevated level of implied volatility, which you can take advantage of. And then the other core component is the intrinsic value, and that's the amount an option is in the money. And then you've got the extrinsic value, that's the price of an option less that intrinsic value. So, the price of the option then is pretty much figured out between these three basic components, and then you have other variables that can affect it as well. So the out of the money options though are entirely made up of that intrinsic extrinsic value, or what we call time value. Now here's an option kind of table to kind of show you, illustrate how again time value can really affect your pricing. So here's time value times the implied volatility times the intrinsic extrinsic, that gives you your option premium. So here, this is based on a weekly option. You start out Thursday, 100% time in your option, and you can see here I put some variables in. You get implied volatility of 300% times that. We kept that constant, so you can see your premium is $300. Now you come in the next day, and let's say the price doesn't move, it just goes sideways. Well, the next day you can see that time decay has taken off about 1/8 of the value of this option. So when you multiply that through, you can see that your premium now has gone down. When you come in Monday, 50% of that time decay or time value of that option has gone away. And even if you have that big spike in implied volatility up to 800 in this example, times keeping this constant, you can see that you barely budge your premium. So it's something that you really need to be aware of and put it to your advantage rather than have it as a disadvantage when you're trading options. Let me get rid of this pen. So, the step 4 then is to understand what is that the market maker's secret. What do the market makers know that you don't know. And this is some important stuff that can really help you, not only if you trade options, but just in understanding where price of the underlying securities can go based on the various statistics that are out there for you to look at for free. So broad markets tend to trend, or they'll move in kind of patterns for 2 to 3 week type cycles. And then they'll trade sideways in channels 70–80% of the time. So you'll notice that markets will go down real hard, and then they'll kind of maybe go sideways a little bit, then go down some more, or they'll go up, then go sideways and up some more, or something like that. So they don't go straight up or straight down, so you have these channels. So based on this kind of sideways price movement, the out-of-the-money option buyers, they're going to lose approximately 70% of the time, because it never gets to their strike, because you're channeling. Now market makers, they know these statistics, and so they tend to be trading from the sell side because they were going to be able to take advantage of these statistics, which I'll go through in a minute. So the professional money is kind of what you want to be able to think like. You want to be able to think like that market maker, and to do that, it's all based on the math. So the market makers, they'll use mathematical market probability statistics for pricing the movement of an option to its expiration. And knowing the probability of an underlying security finishing within a certain range at expiration, that's the key for determining what options to buy or sell and what option strategies to use. And these statistic forecasts, they will forecast how likely it is that an option will fall within a certain price, either up or down, by its expiration. And this statistical forecast, it's referred to as the implied move of the option. And it's this implied move that is an estimate of basically a plus or minus 1 standard deviation move of the underlying security by its expiration. So this sounds all very complicated, but it's really not once you understand it. And so I'm going to go through some slides to show you kind of the basic concepts to hopefully get you to understand this part of option trading, which can really create that aha trading moment once you do understand it. So based on these probability statistics, the short vertical spreads or credit spreads, when used correctly, they'll provide the trader or investor the greatest probability of success, and they're one of the best ways to generate a steady stream of income on a monthly basis. And again, it comes down to the math of probabilities. So here's an example, and this is kind of basically the way it works. So here's Google, and what you're looking at is the at-the-money price. So Google, in this example, we're going to say the at-the-money price is $500. Now, the implied move based on the market makers, and these are theoretical, but these are done by option models. The implied move on this example is for Google to move plus or minus 4%, either up 4% or down 4%. That's what the statistics are saying based on these option models that price the options out, and that's based on the at-the-money price of $500 and to its expiration in 10 days. So here you can see Google at $500 at the money, and so if you go 4% down, that's going to be $480. If you go 4% up, that's $520. So it's this move from 480 to 520 that is a 1 standard deviation plus or minus move, and that's statistically 68.2% of the time. So this is really all you need to know. You can get into much more detail about the math behind the statistics, but this is all free information provided to you on your option platform, and this is what the option traders are going to look at. So here in Google, it's saying in 10 days, the probability is over 68% that it's going to trade between 480 and 520. So you can see that if you're buying these options that are above 520, way out here are puts way below 480, your probability of success really falls off fast. So by understanding these kind of statistics, it can really help you when you're looking at what strategy to use for your trading. So using this probability analysis, it provides the trader or investor a very useful tool for determining price targets to trade against, and it's free on most option platforms. So based on the math of probability, you can see that approximately 70% of options expire worthless. And based on this, it's a good idea for you as a trader or investor to consider also selling options as well as just buying them. So it's this added option strategy that can, really make a dramatic and positive difference in your trading performance if you use it correctly. Trading is a business of probabilities, and to be successful, controlling risk and having consistent winning trades is really what's going to win the race for you in the long run. Better controlling your principal and taking those, consistent winners out of the market. So then 5 is then, okay, well, once you know all this, then what's the right income option strategy that you should be using? Well, the goal, for every trader should be to select a trade based on what provides the most consistent positive return, not necessarily the biggest return. And one of the best ways is to do this by knowing the income option strategies that are available to you, and then selecting the best one that meets your trading style or your lifestyle, because we're all different. We all have different trading accounts. We all have different things that we're doing the day. So it's important to pick the strategy that works for you. So here are the basic strategies for income kind of generation. You've got the covered calls, calendar spreads, diagonal spreads, long iron condors, and credit spreads. So the first strategy, we'll just kind of go through here in case you're not familiar with them, so you can kind of see how they can work, and maybe this is something that fits your style. Covered calls and covered puts are maybe something that you've used. They're the most commonly talked about, and it's basically writing stock options for monthly income. It's writing those stock options. That's the basic component of the strategy. So when you're writing a stock option, the premium from the sale of that option is deposited straight into your bank account the next day. So you keep that premium regardless of what the stock or the option does in the future. So that's the cool part about it. Now the hard part is to keep it once you get it in your bank account. So that's where you come into some other things that you need to know. So in the market, if the market is strong, you want to write stock covered call options. So you want to treat the stock as commodity, just trading it to generally bring you in that monthly income. So it's not that important that you want to own the stock and have it go up that much in value. The options, that's what you want to make your money off of, are those options you're selling it against it, and take advantage of that. And the best thing that can happen to you is to have the stock called away. So that's, writing the covered call. Now, when you're writing stock covered call options, it's great. It's a great source of income when, the stock market's going up. But, what happens when the stock market's fallen off the cliff, which we've seen here over the last month? Well, if the market is weak, you can write what we call covered put options. And that's basically just, you've got a stock, you short the stock, and you sell a put against it. So it's kind of the opposite. But again, it's a way to collect income on a stock in a down market. Now, the other way to do that, my preference really is to use what we call inverse funds or bear market ETFs, and then write calls against those when the market's in a downtrend. And there are a lot of really good ones out there. Here's just a few that you can look at, but some of the better ones, I like to use the, kind of the levered double type or triple type ETF inverse. So I like to use that QID for the QQQ. SDS is excellent. TWM for the Russell 2000 is excellent. So you just buy these, the underlying as the underlying, and then you sell a call against it. So it's a perfect strategy, perfect way in a downtrending market. So here's just a, STS. This is the inverse of the S&P. So you can see if you have the other chart there, as the S&P is going down, this ETF's going up, and you just sell a call against it. Either at the money or out of the money. Play it that way all the way. So strategy 2 then is calendar spreads. And the calendar spread is a neutral option strategy that profits from the underlying stock remaining stagnant or when it's trading in a tight range. And it profits primarily from the difference in the rate of premium decay between that short-term near option and long-term options, or you can even use leaps, which are the very long-term options. And this is made possible by that near-term option premium decaying faster. So you saw that graph earlier, how that premium really falls off when you get to the last 30 days, and this is the strategy that takes advantage of that. So here's kind of the time graph to kind of illustrate this further. What you're going to do here is, let's say you're trading Facebook and it's trading at $65. So let's say you're going to buy the 65 call. You'll be long that, and you're going to go long that 60 days out because it's going to have less time decay, less data decay, and then you're going to short it. Usually you're going to short it the same strike, but in 30 days till expiration. So you're going to be short that 65 call there, and what you're looking at is the spread. So you're looking at this time decay accelerating, and going to zero, whereas this one is only, coming off a penny a day or 2 cents or 3 cents. So it's a really good strategy, when the market's kind of going sideways to maybe gently trending up or gently trending down. So it's a nice income strategy for that kind of situation. Now the third strategy is the diagonal spread. And, this is a version of the calendar spread. And all you do is purchase the in-the-money LEAP, which is a long-term equity anticipation security. That's a big bundle of names there. And then you sell an at-the-money or out-of-the-money call against it. So instead of buying the underlying stock, you're basically buying, the option. And this is, same as a covered call basically, but you've got that underlying option, so you get better leverage to it. And it's great for a situation where you see a market that's starting to bottom out, and you want to take advantage of that. So instead of buying a very expensive, stock or underlying, you can go out and buy those LEAPs, which will pretty much, if you buy a delta, deep in the money, they're pretty much going to go just like the stock. So it's a good strategy for income collection that is more levered. And then strategy 4 is the credit spread strategies, and these are my favorite to use because there are just so many different ways that you can incorporate credit spreads into any and all of your trading or investing. And they're basically, 3 different structures. There's the bear call credit spread, the bull put credit spread, and a long iron condor. And so these are the 3 primary, and then there's some different variations of these. Now the bear call credit spread is basically you're long a call while you're simultaneously short one call with a lower strike. So you're basically hedged. You're short a call, but you've got another call against it to as your insurance. And then you've got the bull put credit spread, which is the opposite. This is a bullish strategy. So you're short one put while simultaneously long a put with a lower strike and in the same month. So they're low-cost directional plays, and when constructed properly, these spreads are excellent for premium collection and for directional type of plays. So here's an example. This is selling a bull put credit spread. This was on WIN, and you can see in this particular trade here, if you look at the chart, you'll see that WIN is trading right here at this particular time at $207, and you're looking for WIN to move higher. So you could have bought the stock or the calls, but instead you sold the out-of-the-money bull put credit spread. So you sold the 187 put down here, and then below it for insurance you bought the 182. You were able to collect $130 there for your credit. Your max risk is the difference in the spread, so it's $370. And if you go to expiration and WIN closes down here below the down here, if it closes above 187, you keep that whole premium, and that's a nice 35% return. And this was, I think this was, 20 days to expiration, so not a bad return there. So that's what a bear call credit, bull put credit spread looks like. And this is a bear call credit spread example. This is on SPX, which is a CBOE S&P 500, and this you're selling way up here. You can see selling above the current market here where SPX was trading at 1994. You're selling up here the 2045 call and then buying above it the 2050 for your insurance. You collected $100 here. Maximum risk exposure is $400, and at expiration, as long as it closes below your short strike here, that's a 25% return. So these are consistent type of trades based on probabilities. So that's what that looks like, and you can see how far above the market it was. This was a 1 standard deviation credit spread above the current price at the money when it was put on. So then the other strategy off the credit spreads is the long iron condor. and it's a combination of the bull put credit spread and the bear call credit spread together. And then basically there should be the equal distance between each strike, while the underlying stock should be between the two credit spreads or short options. So this is a perfect, really great strategy when the markets are kind of channeling sideways. Here's an example on Amazon of a condor, and you can see Amazon trading here kind of in a sideways pattern here. So take advantage of that. Was to sell the 345 calls right here, that red line. For your insurance, you buy the 350 call right here. You collect your credit there, and then on the downside, you're selling the 320 put below down here, buying the 315 below it here, and the total credit from those two spreads turned out to be $150. Maximum at risk is $350. So as long as it closes at expiration down here below the short strike on the call and the short strike on the put, you keep that 150, and that's a 42% return. And this was over like about a 10-day period. So nice trade set up for a really good return and a very defined risk type trade. And you can see here's just basically what it looks like with your strikes, your short strike, your long, short strike, your long on the put spread. So here's a really good way to see this and see how the two different strategies perform. Now this is going to be an example showing you two long directional option strategies. And the first strategy is just doing the typical traditional buy directional long calls if you think the market's going up. The second one, you think the market's going to go up, but you're going to sell in this strategy the out of the money bull put credit spread. So here's when this was back in May. And so the strategy one was to buy the at the money 207 call. That was going for $11.40, so that's $1,140 per one option contract. Strategy two was selling that 187 put, buying the 182. This was below the market out of the money bull put credit spread. And at the time, this spread was below Wynn's prior low of $189. And it was 9.5% below its trading price at the time of 207. So here's, the first strategy. You have infinite upside. You've got, max defined risk of $1,140, but, for a small account, that's still a lot of money. So here's what happens. So Wynn, in this example, right here, start off at 207, but at May the 8th, Wynn falls down here and is trading below that number. It's trading 196. So when Wynn, those call options that you paid $1,040, now you're in the hole $583 per contract because that option contract is getting hit from that down move on the underlying. So that's what's happening there on a long call. Now the next, on the 21st, you can see here that Wynn is improved in price. It's now $205, so it's come back up right here, but you're still below the 207, and you go over here to your P&L, you can see it's still down $518. So this is a great strategy for the market really blowing to the upside, but when it starts to fail, go sideways to down, this is where you can get hurt on these long directional call type strategies. So here's the second strategy. So if you've done this strategy instead, you'll see the difference. It's a big difference. So here's Wynn trading at 207. So you're going to sell that 187 put down here way below the market low. Buy the 182 here. You got $130 credit. Max risk is 370. So if it closes, above that 187 strike, you're going to make 35%. Now let's see what happens when the market comes off. So here's on May the 8th. Wynn comes down here, and on this particular strategy, when Wynn's down here trading at 196, you're only down $38.50 versus the other long calls were down $583. Huge difference. Now on May the 21st, when Wynn came back up, it was now trading at 205. You're still down $518 on that long call. But here you're making money now on that bull put credit spread of $78. So big difference between these two strategies. They're both biased long, but both have different setups. Now, this is my favorite income option strategy. This is the in-the-money vertical credit spread. It's a positive risk ratio, and this is probably one of my favorite trade setups, period. This is an example to show you on Baidu in September. So it's an in-the-money bull put credit spread, bullish. I call it a bullish target option strategy. It's got a positive risk ratio, which makes it very interesting. And this is a trade setup that we did. This was Baidu, nice breakout to the upside using our trading model. You can see the indicators are up, broke a nice trend line. So you could either bought the stock here, bought call options, bought debit spread. But instead, you could have also done a target trade using in-the-money bull put credit spread, and this is what that looks like. So here's just another shot of it on an hourly. Beautiful trade setup. So on this trade, it was selling a 222.50 put, buying the 220 put right here. So it was in the money. Win at the time was trading below that. And so by doing this trade collected $181, but look at the max loss. The max loss here is 69. So that's a beautiful, beautiful little trade setup there. And then this, if you're wrong, the most you can lose is 69. Now, on the second, it was trading at 219.50, and this was put on, the short strike was 222. So you can see it's in the money by about $3 when it was done. So you can see here when it was done, it was 0. But then on the 5th, 3 days later, Win was trading at 226, and the P&L now you had 180. So basically this was a 269% return based on the credit received. And the beauty of it to me is that the maximum loss is only 69 if you do nothing. But there are also ways to defend these trades, so you're not going to even lose 69. So it's a great way to incorporate these type of trade setups with any of your trading. You don't have to do this 100%, but it's just a way to keep your trading more consistent and positive. So wanted to get through this, today, in this hour period of time that I had, and hopefully that you guys can see some other ways to look at trading options or trading the market other than strictly buying stocks or ETFs or going long calls. So I see a lot of questions here, and I'm going to get to those in just a minute. I'll answer those as many as I can. But I'd also like to say that thanks again for having me here today and giving me this opportunity to share some of my trading experience and knowledge with you all. And hopefully what I shared with you in this short period of time will make a difference in your trading. You can see some other ways to go about trading. So I realize you guys don't know me, so I'd like to also share with you real quick an email, and then we'll get into your questions. This is from one of my members. I did a course just strictly on credit spreads, and this is basically what he said here. So we'll get into questions. I still have some time to go through, so I'll be able to take plenty of questions, and I've got some other trade setups I can go through and show you. So, but I just want to illustrate some of my members, what they've seen and what I present to them. So let's now talk about some things you can start doing to generate a more steady stream of income. And then I'll get into some specific trade examples and stuff with the current charts and option chains and stuff for you to see some live stuff. So, what are some other things you can do now to make a more steady stream of income for you each and every month? Well, what I'm going to, offer you here today is my income option course. It's a credit spread course for just strictly income. And it's based on credit spreads. So this was a course I did. It's a 5-hour recorded course and modules, step-by-step, on just trading credit spreads. So it's a 183-page trading PowerPoint manual. And with this course, you'll get all the recordings, all the PowerPoints, and the great thing is if you've never traded a credit spread, it's a step-by-step course. It's only $97, and also if it doesn't work for you, I'll also refund your money. Just send me an email, and that will be done. So this is a fantastic course, and I'll put the link in for you, and you can sign up hopefully, and I think you'll get tremendous value out of this course. So you just put in powercycletrading.com/BEST in your URL and pull that up. Now the course, also what I'm going to give to you today, for the first 30 that sign up, you're going to also get a free follow-up Q&A. I call them the accountability and support Q&A, and it's a live follow-up, and this will be in about 3 weeks. So a lot of times you'll take a course and you have tons of questions. You're not sure really what the answer to those questions are. So we'll do this follow-up Q&A for the first 30 here today, and we'll do this additional follow-up Q&A as part of this special for you guys. Now in the course, in this credit spread course, I cover how to create low-risk, high-probability trade setups, how to use credit spreads on stocks, index options, such as the SPX, NDX. These are great index options to do credit spreads on. How to use non-directional credit spreads and when and how to use these deep-in-the-money credit spreads. This is my favorite trade setup right here, that deep-in-the-money credit spread. Go through in-depth on how to use those particular setups. And then how to steadily and consistently grow a small account. That's what's great about the credit spreads. You can take a small account and grow it with really good defined risk type trade setups. And then a big part is, okay, well, how do you defend the trades when they go wrong? Not every trade is going to go right. So in this course, you also get 6 defensive strategies, for defending your credit spreads in all the different situations that could come up. So I give a lot of detailed examples in this course because I like to learn by seeing examples and trade examples. That's how I learn, and that's how I teach as well. And then the other thing is when to use those iron condors. It's not all the time that you're going to want to use an iron condor, but in the course it goes through the specific situations when to use them and then how to construct them, because you want to make sure that you're above certain support resistance levels when you put these type trades on. And then position sizing. This is a huge part. You can use credit spreads to reduce your risk for position sizing your trades. And another really cool feature is how to take a 70% probability when you put that credit spread on and turn it into a 90% probability trade. This is really cool the way you can do this. And then you get a step-by-step guide for how to execute these trades and the best technical analysis techniques to use for all. Yeah, let me just pull this back up. Sorry about this. Yeah, and here's that link again. Somebody else wants the link. And again, the first 30 that sign up here today, you'll get the follow-up Q&A. So let's go. Let me pull it back to my original PowerPoint. And oh, there it is. Now, okay. So let me go through here. I've got a few other ones that I want to show you. So are you seeing this one? This is Tesla. You guys see this okay? Because see, I'm not seeing my, okay, great. So this is another in-the-money bull put credit spread. Again, I call these target price option strategies, and it's got a positive risk ratio. So this was on Tesla. This is back in August. So the way I like to do these is based on kind of momentum trade setups. So when I see something setting up for a big break to the upside or downside, again, what you can do is you can either trade, what can you do? You can buy the stock, you can buy long call options, you can buy a call debit spread, a lot of different ways to do it. But with those particular setups, you look at them and then you look at the risk involved. And the first thing you'll notice is that when you buy a stock, you're going to have a lot more risk because of the price of the stock. So in here, Tesla's at $232. If you buy that and you're wrong, you buy 100 shares, that's 23,000. Or you could buy those long calls like you saw in that example of a win. Now, if it doesn't go in your direction, then you're going to suffer pretty bad and pretty fast. So here's a nice setup on Tesla. And this is, again, using our trading model. Nice breakout trade. So instead of buying stock or buying those long options, this was selling an in-the-money bull put credit spread. This trade was put on the August the 1st. Tesla was traded at $229, and it was taken off on August the 8th. Tesla at that time was traded at $248. So here's the trade. So it was the August weekly options, 7 days to expiration. The implied move that I talked about earlier, this is how you figure these things out, was plus or minus 4.8%. That gives you your pricing targets that you can use. So that gave you an upside potential target by expiration of $243, downside target of $221. So the credit spread was put on as a target to hit $240, and the market at that time was $229. So this trade was $11 in the money when it was put on. Now look at the risk ratio here. See that? Here's somebody singing. So here you can see the risk ratio. This credit received was $217.50. Look at the max risk. You only have $32.50 at risk here. That's the huge thing. That's a very positive risk ratio. Now, if Tesla at expiration is at $240, your short strike down here, that short put, then you're going to keep that full $217, and that return, look at that. This is how you turn a small account into a big account with low risk. That was a 606% return. Now, I don't know another way that you can get a 600% return on a $32 risk. That's the thing I love about it. So that's a great trade setup for anybody, really. Small account, big account. I like these trade setups. So here, here it is again, what it looked like. You're getting that credit, $217. This is a short-term trade. Max risk, $32.50. Beautiful trade setup. Took it off for basically 590% return on my capital at risk, $32. Tesla blows to the upside. So these are directional trades. Here's one on Baidu. This was back just September the 2nd. Again, this is in the money bull put credit spread. And another nice trade setup, a breakout to the upside. So you could have bought stock, you could have gone long calls, you could have bought a debit spread, whatever, a lot of different ways to do it. But what I like to do then is look, okay, what is my risk on this trade? And then when I look at the risk and I look at these setups, I get very excited. So here's that trade setup, blows to the upside. Here's the bull put credit spread. Here again, $181 credit received. Max risk, 69 bucks. Ended up making 269% return on capital, based on this structure. So a beautiful trade setup. Here was Twitter. This was another one. Twitter was moving back to that prior high. It broke back above the 618 retracement. I'm big on Fibonacci. And this is another thing in that course, if you sign up for it, we go through how to use Fibonacci, for your price trade setups to take advantage of these different support resistance levels that Fibonacci gives you on a free basis. So here was a Twitter trade setup, and here was Twitter. This was actually a 1-to-1. You can see risk $24, $26, profit potential. This is a pretty cool little trade. Look at how narrow the strike is. 50-cent wide strikes. So these are cool things you can do once you understand these strategies. So this was a 2 days until expiration. This was, done on a I think a Wednesday and taken off for expiration on a Friday. So great way to use weekly options. And this was a 108% return on capital based on that little structure there. So these are fantastic trade setups. Here's the NDX. Here's another one. This was NDX this is basically a 1-to-1. It was trading here. This is the NASDAQ 100 SPX. It was trading at 40.27. So this trade was selling the 40-10 calls, selling the 40-15 calls. This is a bear call credit spread, almost a 1-to-1, collected $215, max at risk $285. Oh, here, this is at the 40-15. Yeah, these are two different trades, and then selling the 40-10, and then this was selling the 40-10 calls. Oh, here's one we did last week. This was on Chipotle Mexican Grill, and this was a really nice one. Chipotle was, looking to break out, so we put this trade on. It was, trading at around right here. You can see it was trading at 632, and it was starting to go through its 382 retracement level. Our indicators were looking good. So, instead of buying the stock or buying the outright options, did this bull put credit spread and collected $185 credit. And the max at risk here, you can see this was on 2 contracts. So max at risk was $65. And then, this was taken off. This made about 120% return in 1 day. This was like a day trade, basically. And so it was taken off the next day when Chipotle was at 243. That credit had crushed down to 65 cents. Bought it back in, made 120 bucks per contract, and very defined risk trade. So these are the kind of setups that I really, really like, and that's what I wanted to pass on to you guys here today. And here's that link one more time, and then I'll take some specific questions here and see what I can do for you. Let's see here. Oh, thanks, Gareth. Gareth bought the course, and yeah, so we'll have that follow-up Q&A in about 3 weeks. I'll send an email out on that for the first 30 here today. What are the odds of Tesla moving up $11 in 7 days? Well, pretty good. Tesla can move $11, where Tesla was trading at that time at $250, something like that. And the way, that's only a 4% move for Tesla. So, you got to, look at what you're trading. So the odds are good on something like that when you have a momentum type trade, when you have a momentum type stock like a Tesla or a Priceline. There are a lot of these guys that are, that go nuts, and they have huge movements. So those are the kind of stocks that I like to really specifically look for. And I keep a watch list of these high beta type stocks like a Tesla, like a Priceline. When they're moving, like a Chipotle, when they're moving, they're fantastic to trade, and they can move that big. Now the thing is, that's a good question though, what are the odds it can move 11 in 7 days? Now if I'm wrong about that trade, then what was my loss? Let's go back to that trade. That's the beauty of this type of strategy. Let's get back there to Tesla. Okay, so here's Tesla. Okay, so Tesla, see, this is another thing too, that this is my trading system, and this is why I did the trade. See these green dots? This is what we call a volatility compression squeeze. Now, my model, this is my trading model. It's a proprietary model that I use. When I see this squeeze set up, and I have my momentum indicators showing to the upside, this is the kind of trade I'm looking for. I've got a scanner that scans looking for these type of setups. So when I have this and it pops up on my watch list, based on the scan I'm running, these are the trades I want to jump on. Now, your question is, though, what's the odds of it going up 11? Well, in this particular situation, there's a good possibility, good probability that it will, based on this kind of setup. But if I'm wrong, if I'm wrong on this trade, the maximum I would lose is $32.50 if I did nothing. So that's why I love it, because then you can take, you can even be more aggressive on these type of trade setups, and the wider, the more out of the money, deep in the money you are, the bigger credit you receive. But your max loss goes down proportionately. So it's a great way to protect your downside and know exactly what your risk is, while giving you a big upside potential, in this particular situation, over 600%. So that's the thing that's so sweet about this type of trade setup. And that's part of what's covered in this course on credit spreads. So there are 3 basic kind of credit spreads. We went through the basic structures, but there's then selling the in the money, at the money, out of the money credit spreads, and then when to do those, how to set up the trades. There's a lot more to it than just looking at this graph. And then what are the best conditions for doing these trade setups? So once you understand the progressions of the trade, then you can look and know, okay, I'm going to use this out of the money credit spread. Oh, I'm going to use at the money. Oh, I'm going to use in the money because I can protect my risk and know what my risk reward is. Yeah, we have a trading room, virtual trading room, and that's something that you're also available to you once you sign up for the course. You can send me an email at larry@powercycletrading.com, larry@powercycletrading.com, and I've got a trading club, $7 for the first 30 days, and then it's $97 a month. And it's, we have Q&As every week, send out daily aftermarket video updates, to all members, a lot of great free bonuses, a lot of really great benefits for the trading club. So you also get the virtual trading room, which is open each day, that you can come into and watch my early morning trades. I pretty much trade futures in the first hour, and then if I see an option trade set up, I'll come back in the room later in the day to show you the structure. So right now we're doing some various earning type trade structures with options and a lot of good stuff like that. Let's see what else. Yeah, the first 30 will get the additional follow-up Q&A, and that's a great way for you to get some additional coaching with me as far as how to use and incorporate these type of trade setups. Yeah, my email address here, I'll put it down to you here. Oh, hold on. Okay, so it's larry@powercycletrading.com. Just seeing if I spelled that right. So that's that's why I love options so much, because there's so many different ways that you can trade something, and if you know the options and how to go about using them, it just really gets you controlling your downside risk. And that's what I'm really more comfortable doing these days. As the older you get, the more conservative you get. You can make a tremendous amount of money just by buying those long calls, but you can see from that one example, you can lose a lot of money very fast as well. So these type of trade setups using credit spreads, and it's not something you have to use 100%, but it's something that I use pretty much on any trade I'm doing. I'll always throw in a credit spread with it to diversify my risk. Here's a question here. Do you find that since the market has basically gone up straight for 2 years, credit spreads are easier or harder to make money on versus a more sideways market? What time frames are you using? Why 30 days, etc.? Okay, so I don't think they work in any market condition. So the market's going straight up. There's always ways that you can use a credit spread because they're a directional type of trading strategy. And then you can do, like I said, you can do in the money, out of the money, at the money type of credit spreads. You can do the bear call, bull put. So there's so many different variations that it just gives you a lot of different opportunities. And the thing is, the probabilities are in your favor, just based on the map that I tried to lay out to you. Now, in the trading course, I go through a much more extensive, detailed explanation of standard deviation, implied move, how to calculate it, how to do your target price analysis. So for $97, you'll come away understanding everything basically about standard deviation for your trading, how it comes about, how you derive it, how you do your implied moves, how you figure it out. So it's a great thing for you to do. So again, you can use these in any time frame. You know, these trades I'm showing you, these were 2 to 3 days. I do other credit spreads on the index options where usually I'll go out 20 to 30 days and just put those on, you know, looking to make 10, 15, 20% on a very low risk type trade setup. Question, how do you deal with the wide bid offer spread on price line when doing a vertical? You know, if you can't get your bid offer spread narrow enough, then I'll pass. But you know, there are a lot of times where you can get price line, the spread's okay. So you know, it's just case by case. But you know, a lot of times those spreads will be just fine. Other times they won't be. But you know, it's a case by case situation. And a lot of times I have passed on price line just because of that exact question, Joe. But there are plenty of other things that you can, you know, find. Yeah, does this work with pre-earnings? Absolutely. Yeah, these are the type of trade setups I will also incorporate into my earnings type trades. And I do, you know, got a whole course just on that, just for earnings trades based on options, non-directional. Yeah, you're welcome, Tanya. So again, if you are interested in learning, you know, just starting out in options and want to trade options, this is a great place to start. And you're going to be, you know, getting to pick my brain. I've been doing this a long time, so a lot of these answers that you get are from my past mistakes trading, so hopefully I can pass on the good stuff to you versus you making the same mistakes that I've made. So, you know, when I see stuff like this, I like it because, you know, options can be, they can be unforgiving as well. So, let's see. Yeah, so my virtual trading room, it opens at 8 o'clock 8 o'clock Central. So I open the room up at 8:15. Market opens at 8:30 Central. I'm in there trading. I usually trade the NASDAQ futures, and you know, just for day trading. So I'll trade there for the first hour, hour and a half, and I'll show my trades using my trading model. And then, you know, the trading model is basically, you know, this is what it looks like. I use this for, you know, all my trading, and I'll break it down based on the different time frames for my day trading. So I've got 3 indicators, lower studies. These are 2, the cycle 1, cycle 2 are momentum type based indicators, and the cycle 3 is a overbought, oversold oscillator that I use. And then I've got this volatility compression indicator built in, and then I've got support resistance. I've got you know, candle recognition, right? You can see that red candle there. You know, I got a lot of different features built into this trading platform, which is also available to anybody. And I've got my platforms coded for Thinkorswim, TradeStation, NinjaTrader, and eSignal. And then my scanner, I've got a scanner that scans for these volatility compression type setups. And I've got this model for Thinkorswim, TradeStation, and eSignal. Thanks, Kent. Yeah, thank you for buying it. And you know, it's a lot of material, but you'll get a lot out of it. It's again, the PowerPoints are fantastic because they're like a specific manual that you can use. So I'm very detailed in my courses and put a lot of that detail, you know, on the PowerPoints as a trading manual. Okay. Yeah, just send me an email here. I'll give you, if you want to join my trading club, I'll put that link in there real quick. Here, one second, I'll put that link out there for you. If I can find it. Here it is. Okay, so that give you the link there, $7 for the first 30 days. You can cancel anytime you want as well, but a lot of great benefits to my trading club. Now my indicators are separate. You can go to my site, powercycletrading.com. They're $300 for the indicators with the manual, trading manual, and videos, and the scanner's $300. But if you become a member, and all you have to do is join the trading club, $7, and you want the indicators, then I'll give you a member's discount price, which is 50% off, basically. So if you're interested in that, you can go to my site. You can look at the indicators. But again, then if you join the club, you'll get the indicators for, I believe it's $147. And the scanner you can get, I have a package on that. You can get it all for about a little under $300, and it's just the best trading tool you'll find for the price. And this is what I've been using. I've been involved with trading systems since the late 80s, and we use a lot of different systems, and this is the one I developed. I started putting this together back in 2009, 2010. It's what I use for all my trading. So you're welcome to that. And again, you become a trading club member, and then if you want the indicators, just let me know, and I'll give them to you for half the price. So I believe it's $147 for the indicators plus the manual, and it's about $127, $147 thereabout for the scanner, and the scanner is really cool. Yeah, join up today. Here, I'll show you the scanner real quick. Let me, if I have time, I'll show you what it looks like real quick. Yeah, I can't show it. I had my computer, I had Windows 7, and it got corrupted and crashed, and I had to just buy a new computer and everything, so I don't have all my tools set up quite yet. But go ahead and check out the site. You can see the scanner on the site. Join the trading club and come on in and let me know. Yeah, Roxy, just give me your email address and I'll just guarantee that you're in. See a lot of orders coming in. Okay, thank you. You're in. In my trading club, I send out daily videos after the market closed. And in the videos, I'll put out any trade setups that I'm looking at. And then, in the trading room during the day, if you're in there, if I see something specific, I'll throw that out as well. Thanks, Roxy. Appreciate that. Yeah, please do. Roxy, appreciate that comment. She said I was a good speaker, and I appreciate that. I'll be speaking at the Money Show if you guys are out there, so on the 22nd. So I'll be speaking out there if you want to come by and see me. Big Vegas. The hours of the trading room open up about 10 after 8 Central, and then I leave the virtual trading room. I'll leave my charts open all day. I'm going to only be in there for about an hour till about 9:30, sometimes 10. If something specific's coming up, like the FOMC announcement at 1, I come back in, and I'll come back in usually during the last 30, 45 minutes of the day. We're doing some earnings trades now. I'll probably be doing Tesla, setting up an earnings trade on that for today after the close, and I'll come into the room and show what I'm doing on that. So that's kind of how it works. Yeah, let me put that here. Let me get back to the here's everything you get here. So it's a 5-hour recorded in modules, step-by-step course on credit spreads, and then the manual is a full training manual, PowerPoint, and again, the first 30 of you guys will get the follow-up Q&A. So, you know, for 97 bucks, you're going to get a lot for your money. Gold is another thing that, you know, based on our trading model, that's something else we picked off really well about a little bit over a week ago. The move down on gold, so bought GLD puts and put spreads on that. I just bought options. So I bought puts, bought put spread, you know, and looking really good. And that's something else that you'll get to take advantage of my kind of global macro views. I've been doing this a long time, so that was all based on the dollar and based on my trading model showing the dollar breaking out on a big macro move. And so then the correlation is, okay, well, what do you do with the dollar going up? So then we go through and break down what are the areas to benefit from. Well, one is that crude oil goes down, gold goes down, euro goes down, yen goes down, and we jumped into gold, and it turned out really nice. Yeah, in the course, defending the trade, I've got 6 strategies for defensive adjustments and for various different, you know, market conditions. So, you know, a lot of detail on how to defend a credit spread and under the various conditions of the market. So that's a big chunk of the course there that's worth, you know, the $97. Yeah, there are a lot of different ways to adjust. You know, you can do additional spreads. You can convert it to butterflies. There's just a lot of different ways, and I show you in the course how to do that, how to shift the risk and reduce the risk. So that's worth the $97 there, just to learn how to defend and make adjustments on a trade. Because the easy part is again collecting that income, putting it in the bank, and then sometimes, you know, it doesn't go exactly like you planned, and then what do? So those are all gone up, you know, all that's covered in the course, and 6 different defensive strategies. So what you want to do is you want to defend the trade. You never want to lose your full credit. So you want to make adjustments and keep as much of it as you can, and then go on to the next trade. Yeah, so good point. You'll have 80% of your spreads work well, and then, you know, 1 in 5 don't. So what do you do there so you don't, you know, give it all back? And that's a lot of that's covered in these defensive strategies. And a big part of it is, you know, knowing when and when not to put on a spread. You know, it's all based on direction. So if you get the direction wrong, you know, you're gonna have a lot more spreads that are going against you. Yeah, Garth, I hope I didn't mess up your name. Appreciate it. Yeah, you know, it sounds like you do a lot of spreads and you know a lot about it. But, you know, like I tell my members, trading is a journey. You know, there's no perfect trader, no perfect system, and it's constantly learning. I'm constantly learning. I learn so much from my members, so that's the thing I love about it. It's kind of a really good mind exercise each and every day.